nice, they're really good.
Tasty, like flavor seasoning.
Hey Cora, how are you? Pretty good. We're glad you're here. It was the first time we met here and told me about. We had the first time of our programs.
Oh my God. And,
Yeah, I'm sorry, that way, I don't have it really filled out that way.
No, I have to look at things.
All right, so basics want to get started. And the first sheet here, a little precursor to that. Yeah, so that's, hi, please grab one of those. No, turn around, just in front of you, on the table. Yeah, right. Basically, this first sheet, the reason why this is big news is when COVID hit and you had a pandemic and the markets kind of triggered a little bit and lenders started to pull back on what they were doing. One of the things that FHA and VA told the core lenders were, hey, we're not buying anything below 660. So anything below 660 we couldn't do with FHA and VA. None of us could. They had to raise the bar to make those loans more attractive on the secondary market, especially since financial markets were going down pretty heavy at the time. Now, with everything, the markets are back. Basically, COVID supposedly is under control. Everything's working towards getting back to normal. They lifted a lot of those bands, and they dropped from 660 to 640 to 620. Now we dropped it down to 580. Not every lender is doing it. A lot of lenders are still stuck on 640. From what he understands, like USAA, big VA lender, I think their minimal score is 640. We're going down to 580. And where this helps is that before you would have to basically wait it out till the credit score came out, or we would get them on a credit tool program. With this program, we just did one for Connor. Connor said, hey, can you do anything with this? And I said, sure, let me run it through automated underwriting. And it took. And 24 hours later, she was under contract. And we were able to get her pre-approved through automated underwriting for $25,000 more than what she was pre-approved elsewhere for. But she would have had to get her score up to 620 from a 587. So just so you know, this opens a lot more doors for your buyers. But the only thing about this is not instantaneous. When I pull that pre-approval in, I'm going to be getting everything I can get from the borrower, like pay stubs, W-2s, tax returns. I want to make sure I'm using the right income, because once you drop down below a 600 credit score, the algorithm for the underwriting tightens the debt ratios. It used to let you go up to here with your debt ratio. It tightens it a little bit because they're like, hey, you're already a risk. We're taking a chance on you. We don't want you to extend yourself too far to make sure that you can make these payments. So I have to get the documentation in. Sometimes it depends on how quick the people are. Could take 2-3 days. Then once I have it, we'll run it through automated underwriting and let you know whether or not it's going to fly with the credit score under 600. So I just want to let you all know, as I'm working with one from Michael Holloway, got the file in last night, waiting for the bar to upload the documents so I can see what I'm working with. Sometimes we can verify their employment. It's called the work number through Equifax. Sometimes we can verify it electronically. It gives us the income, how long they've been there, their bonuses, their overtime, but not every employer subscribes to it. So just want to let you know, it is back and available for the FHA and VA, and that was a big thing because it was just limiting us. If you go to the second page, I get asked a lot of times, Frank, you guys do commercial, do you know somebody who does commercial? We are doing commercial, but we're not doing it directly. We partnered with a company who we will take the information, basically do a profile, we do an online profile with the consumer, and then we turn it over to our commercial lending partner. And here's what they'll do, and it's great. We've already done a few of them, and they worked out really well. It's commercial program and residential rental programs, 5-year ARM, 30-year fixed rate with 15, 25, or 30-year amortizations. 20% down, full doc, and bank statement program available. So you can buy a commercial property, not provide tax returns. As long as you can provide the bank statements to show the income's coming in. A lot of self-employed people, the money's coming in, but when the accountant gets it, they get real creative and it doesn't show on the tax return. So that's a great program for them. Here's the eligible properties you can do, which is pretty fantastic. Automotive, like an auto body shop, light industrial, mixed use. You know, you have a business on the bottom, a couple apartments on the top. That works well. Mobile home park, Not sure how many times you guys are selling those, but multifamily, 5+ units. What's important about that is Fannie Mae and Freddie Mac and FHA and VA, they go 1 to 4 units. That's it. If you have a 5-unit building, you can't do it. This is a program you can do. Where you have to go through the bank, which a lot of times the banks are just like ridiculous when it comes to that. They want 30% down. They want a crazy credit scores. This is like a 660 credit score program, which is phenomenal. Retail, yeah, buy a couple, maybe a little strip mall or something like that. You can do that. Self-storage and a warehouse. And ineligible properties, they went from one extreme to the other. Adult entertainment and then churches. Neither one are eligible. Can you do adult entertainment and a church?
Mixed use.
I don't know yet. We created a third category. Gas stations, hospitality, basically a motel. New construction, raw land, or restaurants. I won't do any of those. Because basically, in the opinion of the bank that does these, is those are your more riskier businesses that don't last. So that's first 2 parts of the topic. Now here's the meat and potatoes of what I really wanted to go over with today. A lot of people cash strapped, they need money. Sellers are not giving concessions the way they used to. I'm starting to see it a little more, but it's 1 in every like 50 deals, where it used to be 25 in every 50 deals. They're not giving them, it's just too much competition out there. And in order to get the $10,000, you had to go FHA, or if they were VA eligible, go VA. So when you're competing with, you know, cash offers, conventional offers, you're not winning. So we're able to get together with Freddie Mac and the NJHMFA to do the Hfa Advantage. What it is that $10,000 program. Same guideline, where you have to be a first-time home buyer, meaning they couldn't own the home in the past 3 years. Now, the only difference is, what they changed with these programs was, before it was the household income. There's income limits on these, and I have them on these sheets. But it used to be the household income. So if you had husband and wife, and you know the wife wasn't going on anything, or the husband wasn't going on anything, they still said, okay, we need to see the tax returns, we need to see everything, because if the household income, regardless is on this mortgage, is above the limits, they don't qualify. Now they changed it to, it's just based off of whoever's on the mortgage. So if you can qualify with $70,000, you don't need the spouse's $60,000 to make it work, we can do this. The thing about the conventional program is, the main thing about the conventional program is a couple things. You can do it 3% down. When we run these through the automated underwriting, we're using a lower PMI factor, which is great for the conventional one. It's about half of what the regular PMI would be. So that's a win right there. Hey, Brian, want to grab one of them up there? And if you're here after, I can go over what you missed. Basically, what we're saying is the grant programs is basically, for the conventional, is the same as the government one. It's still the $10,000. You can use it towards down payment and closing costs. First time home buyer, 3 years, paying out to own the home or have any interest in a home. But with the conventional program, the PMI, the factor is half of what it would be for a regular conventional loan or for FHA. So it makes the payment cheaper. But the one caveat here is, the algorithm for the underwriting is a little strict. It's looking for credit scores around 700 or higher. If not, it comes back as a refer. What a refer is a nice way of saying no. That's what that is. So they're looking at a little higher credit score. So if you have somebody, has kept their credit in good shape, they're light on cash, and looking for a $10,000 grant, but you're having a hard time getting accepted with an FHA program, the conventional one is here. Now, if you flip the page, it gives you the income guidelines. Maximum income limits, and it goes by county. Mainly, we're looking at Burlington, Camden, Gloucester, right in this neck of the woods. So you're looking at 75.6. Now, that is something where that 75.6. Say if they make $70,000 a year, but they're getting another $10,000 a year in bonus, and maybe another $5,000 a year in overtime. We're over. Well, maybe. If we can qualify just off that base income, don't need the overtime and bonus, because it's not guaranteed, You know what I mean? If we can say, hey, show that they received it for 2 years in normal circumstances, we need that to qualify, we can use it. But if you don't need that bonus and overtime, and their base income doesn't cross over that maximum income, you're fine. And that will be us to determine that for you. And so most of the time, if I get somebody making anywhere north of $65,000 a year, I run an income through the work number in Equifax just to see what they're pulling in for overtime and bonus if I'm going to need it. If I don't need it, I'm going to use the base. As long as that base is below 75.6, you can get that grant in our counties. Be careful if you drop down to Atlantic County, it's dropping down 10,000, pretty much, 9 to 10,000. So, you know, like Amber Cruz, she does a lot down there, and this is one thing where it's going to affect her buyers down there for this. Now, if we go to the next page, statewide limits for FHA, VA, USDA. This is for the government one, the government grant program. If you'll see that the income limits are much higher. Now, the government program with the state of New Jersey, there's the first-time home buyer, and then there's the road home, which is the Smart Start. One program has a little lower rate, and then you have the secondary program. If you flip the page, you'll see the secondary program. Look how high the income limitations go up to. In our area is $148,400. So if you have somebody making $148,400, they can still get the $10,000 grant, but you'd have to use FHA, or if they're VA eligible, the VA program. Right? But the keys here are all explained on the NJHMFA flyer. What you need to have. You need to have first-time home buyer, or if first-time home buyer is defined by not owning a home in the past 3 years. So if you have somebody who's owned the home 34 months ago, you're not taking them out to look for another 2-3 months. So, you know, and that's the thing. We'll be able to tell you if they've owned the home or not just by running the credit report, seeing a mortgage on there, or, you know, if they're not going to be forthright with you, because a lot of times people think, oh, I haven't owned a home. They're not going to tell you they owned the home because maybe it was mortgage free. Well, on our end, we have to run a thing called Fraud Guard. It does a deep dive, and it tells us what homes they owned, and, you know, so, and the state does that too. So they make sure that the money's going to those people who really should be getting it. I know that was a little quick, but the main thing was just to get out to you 3 new things: the 580s, the commercial stuff. And you'd be surprised. Every now and then you're going to get somebody to pull you up, and sometimes the commercial deals, they're $2 million deals. So if your average sales price is $300,000 on your residential, you have 7 to 8 deals right there. So it's a good thing not to have to pass that up anymore, because those commercial people also buy homes. And wanted to get out the fact that we do it now for the grant on the conventional side, which is going to help you. But keep in mind, for these grant programs, we're still dealing with the state. What that means is that when we send the file to the state, we have to have title in, we have to have homeowners in, we have to have the termite in. So basically, we have to have a clear to close, ready to close file. Then, and the homeowners is important because they want to see what that premium is to make sure that the debt ratio is met. It's not going to be, we're saying it's $80 a month, come in $150 a month, now they don't qualify. Then, once we have that, we scan the file, we transmit it to the state of New Jersey electronically. That's where the fund begins. Sometimes they'll look at it in 2 days. Sometimes, depending on the volume they have, they won't look at it for 2 weeks. So if we're dealing with 3 weeks to get an appraisal in most cases these days, then we have to have everything in. You're talking about 30 days, typical to close the transaction, unless the appraiser can get out there and get that done fast. Then we got to get it to the state, so it could be 2 to 3 weeks there. So that's why we say 60 days. So with these, if you write a contract, we're going to do this, keep in mind, let's try to use the 60 days as a guidance, because we can't control the state, and the last thing we need is the seller pulling out because we missed our settlement date. You know, a lot of these people, they need that $10,000, they just can't go find it somewhere. You know, so that's a key. That's a key to that. Questions, anybody? Everybody? Yes?
The credit score for the FHA, VA, USDA, is that also gonna be?
Yeah, good question, very good question. The credit scores for the, I can go something afterwards. The credit scores, to recap, great question. For the credit scores for the first-time home buyer programs with the grants, For the conventional, want to try to get a 700, but for the FHA and VA, it's 620. They haven't dropped their scores to 580. They're like, nope, we're 620 because of the fact that they're actually the one that's transferring the file to the state. I mean, to FHA to get it insured. So they want to see a 620. But like I said, if they don't meet the grant, we can go down to 580 on those FHAs and VAs. So this will help a lot of people who are just like stuck in that rut where they're renting. They have their bills, they have their rent, they have the utilities, they just can't get the money together. You know, maybe they can get 4,000 or 5,000 together with this 10. That helps a lot. Especially if you have, if you have a $250,000 sales price, if they can come up with 5,000, 3% down is 7,500. They have 7,500 for closing. That's going to be real close to getting you to the finish line.
Not have to ask for concessions,
Right, they're not going to have to ask for concessions. Yeah.
So
Yes.
what is it for USDA, the credit score?
Same thing, 620.
620.
620, yeah. And what we'll do in some cases, if somebody's running a little short on funds, we can have them prepay their homeowner's insurance on their credit card. They can prepay the appraisal on their credit card. They can prepay anything on their credit card. And it'll show up as POC at closing, so that's less funds they have to have liquid. Then they just have to worry about paying the credit card bill, but for the most part, that's how a lot of people are getting into a home. They're prepaying stuff and they're worrying about it after the fact. Because when you get in, you have minimum of 30 days for the most part before you have to make a payment. So they have time to get the money together and pay off that credit card in the interim. Yes, Brian?
How are concessions impacted?
Concessions are done the same way as usual. 3% on conventional, because if you're putting less than 10% down, if you need the $10,000 grant, you're pretty much putting less than 10% down. So you're looking at the concessions would be 3% on conventional, the FHA, the VA, and the USDA at 6%.
So you can get the 10,000 plus?
Yeah, say if you got 250,000 sales price, and you somehow you're able to get 4%, say.
Yeah.
There's 10 grand, you get $10,000 grant, you got 20 grand. We've had scenarios where that's played out with VA files where we have too much money. All right, well, let's put a down payment. Now that people have equity and their payment's cheaper.
So there is a max they can get back?
Yeah, absolutely, yeah. I mean, no, anything they get, in other words, if you have too much money in the transaction between the seller concession and the grant, we can apply the seller concession to cover the closing costs and the grant to do the down payment. But say if the down payment's only $6,000 and the grant's 10, well, you can make the down payment now 10 grand. Because it's universal, you can use it both for closing costs or for the down payment.
So the conventional program, the income limit is 75.
75.6, yeah,
Now, you said that the minimum-ish credit score is around 700.
for the
Does the
conventional,
rate
yeah.
change, and what's the rate?
The rate right now is 3.125.
Okay, and is that the same for FHA?
Now the FHA has the two prong. The FHA has if your income limit is is the first limit, where it goes up to 106,000.
Yeah.
That's the lower rate, which right now is 3%.
Okay.
But if you cross that and you have to go with the Homeward Bound program, which is the same $10,000 grant program, they just label it differently for the grant allocations.
Yeah.
The income's up to 148.4. That rate right now is 3.5.
3.5%. Okay.
Yeah.
And now for conventional, if you're higher, like if you're 800, there's no difference. 3%, 3.125% across the board.
No, this is a standalone conventional program.
Okay.
So if you're it's a scenario where whatever your credit score is, as long as you go through approve eligible, you're going to get the same rate. You won't get a better rate if you're at 800.
Okay.
Okay.
And 60-day close for conventional as well.
Yeah, and anytime the state's involved, we have to use
Okay.
60 day.
Okay. I just wanted to make sure for all the states.
The lock-in is actually for 70 days. So it is covered there. You can get one of those. Thanks. Yeah, you will. Everything's spelled out in there. But the lock-in is for a 70-day period. So what's that tell you when the state says we're going to make the standard lock 70 days?
Yeah.
You're going to need it.
Yeah.
Yeah. They're not. The thing about the state is we have a great rapport with them. We really do. But I can't pick up the phone and say, "Hey, can you rush this?" Because they take it and they put it to the bottom of the file. You know what I mean? And they don't work overtime. They don't work through their lunch break. They don't miss a smoke break. They do. You have to understand, this is job security in that environment. You know what I mean? Hey, we got a backlog of files, it means nobody's getting laid off, you know?
What about association fees and capital contributions? They can be time sensitive
Well, at the, what
as
do you mean?
far as like paying them, you know, when, just pay them up front?
For the association fees?
Yeah,
Well, normally, they're, you know, the newsletter is, we just put that on the CD. But you're saying some associations want their fees early, you know,
yeah,
upfront?
like for example, if in some communities, they want a capital contribution up front. Let's say it's $650, that's your initial capital contribution.
Okay,
That would be paid by them up front.
that would be paid by the consumer upfront, yeah.
Okay, and then, okay.
Why would you pay that before closing?
Yeah,
What if you don't close?
Well, see, that's my question.
yeah, I haven't seen that often, but I understand what you're saying.
I
That's,
just think because they're spending money, you know, they're
Right.
being told that they're buying anything
Yeah.
or doing anything.
that's, anything upfront that they spend is not reimbursable. So it's almost like a home inspection.
Okay.
You know what I mean? When you do the home inspection, that's why, a lot of cases, we try to wait until the home inspection is done for order and appraisal. But if we have a 30-day close, we have to jump in right away. It's like, I hate to have somebody spend $1,000 on a house they're not gonna buy. Because they're like, well, why'd you order an appraisal? The home inspection went bad. Well, I know, but if we didn't order the appraisal, your contract would have went bad. Would have never got an appraisal back in time to get the settlement. You know? Like, so that's why we try to keep conscious of the buyer's funds. But, you know, something like that would be, it's a POC item, just like a home inspection would be. Don't you look like you have a question?
I have a quick question. What's the difference between the Homeward Bound program?
Right, there's the first time home buyer
Right.
and the homeward bound. Homeward bound is basically just a way of saying, hey, we're gonna give you the grant, but you make a little bit too much money, but you can still get it, because that's where it goes from over 106 and change up to 148. You're still gonna get it, but we're gonna charge you a higher rate. That's how
Much
they,
higher.
it goes from 3% on the regular first time home buyer to 3.5% on the homeward bound. Right, well, it's their way of legally being able to say, hey, you make the money, you know, we're gonna give you the grant, do you really need this grant, making $148,000 a year? If you want it, it's gonna cost you. And but that's the mentality, yeah, a lot of people do, you have kids in college and
I
whatnot.
have a girl who's an attorney, and she's, every time she goes to club for mortgage, she gets a raise. So she's right at the cusp, so
Right.
that throws her over top.
Right.
It's like,
Right.
it's still 3.5% raise, still a great grade.
Right.
You know.
Right, but yeah, that's just it, they're saying if you're above this,
But she's got
It-
student loan debt, you know, and she pays them all.
gotcha. Yeah, but the mentality that they use is that, hey, you know what? We're gonna open it to more people economically sound, some people a little more economically sound, but you're gonna pay a higher rate. So it was their way of being able to give out more of this money. Now, keep in mind, with the conventional and the government ones, it's still the same 5-year plan. You have to live in there for 5 years. You can't refinance that mortgage for 5 years. If you do, you have to pay it back. Because what that is a soft second mortgage. The reason why I use the term soft is because there's no payment. There's no interest. And it's a second mortgage that's recorded. But after 5 years, it automatically gets canceled and satisfied by the state. So it's now off your title. You don't have to pay it back, but you have to be there for 5 years.
And
Yes.
if they sell earlier, then it's the full 10,000.
Full 10, yep.
So it's not early.
It's not, at one point years ago, they used to prorate it.
Yeah.
Now it's like, because, I don't know if you remember years ago, if you weren't in the industry, they used to run out of funds. Now, because it was state, it is through the state, but it's backed by the federal government now. It's not backed by the state of New Jersey government, basically local government. It's backed by the federal government. So now it's like, okay, we're not gonna run out of funds, but you're not getting a break on that money. If you leave in 5 years, you gotta pay it all back. But some people are like, hey, my house went up $60,000, I don't care. You know, that's where it helps some people right now. You know, and you know, you have some people call me to refinance because they got it 2 years ago, the rate was 6%. So they call me saying, hey, house went up 50, 60, 70,000 in value. I want to refinance, I'll roll it into the new mortgage at 3%, I'm saving $400 a year. It's no big deal. You know, they'd rather save the $400 a year, it just makes their life a lot easier every month.
right, so the conventional program, to go back to that, 75,600, where do you see that as being like a good price point for borrowers?
If you have like modest, 75.6, you're talking about like $6,300 a month in income, right? So say to have minimal debt and say your front end ratio you use as say 35%. You're talking about like a $2,100, $2,200 payment. So maybe you're talking about like a $250 home.
Okay.
$250 with $6,500 in taxes around there. What's the good thing about it is they get a discount on the PMI. The PMI is 18% coverage. Now you have to look at this, 18% coverage, it's $18 on every like 10,000 borrowed. Where FHA is 85, when you break it down into the dollars, the FHA percentage, it's 0.85 is the factor, but it's really like a 30% coverage. So the FHA is like more like $36 on every 100,000 borrowed. So it lowers the monthly payment and it helps them qualify to get them into a little bit of a higher home.
Frank, what do you mean by 18% coverage?
All right, PMI goes by coverage. 18% coverage, meaning that they want 18% of the loan guaranteed in case there's a default. So the premium is X because you're only covering 18% of that loan. But if you go into a regular 3% down and you make above 75.6, it's 35% coverage, where they want 35% of the loan guaranteed.
So the PMI is half.
The PMI is half.
In that example, 3%, 5% down, which is what most of these buyers probably would be in anyway. What's like an estimate on a PMI for 250,000?
Well, 250,000, you're probably going to be running about, I would say only 18%, about $50 a month.
$50, so it's like $25 a month savings.
Yes, absolutely. $25 to $50 a month savings easily. Yeah.
25.
Yeah.
Okay.
And that's where, say if it's $40 a month savings. Well, if you're using $5 per thousand, that's $8,000 more in buying power.
Exactly right.
Yeah. So now if they get into a little bit of the bidding war, they can go up $8,000 more versus if they were traditional, conventional.
And then you said that it's only one borrower even if you're married, right?
Now, if you're married and you need both incomes to qualify, you can't go past 75.6. But if one of the persons in the marriage, they make enough money to qualify on their own, and that income is below 75.6, we just use that person on the mortgage.
Right. So if you had somebody making, a couple making, somebody makes 74,000 and somebody makes 100,000,
Right.
you're good.
If you don't need the 100,000.
If you don't need 100,000, you're good.
Right.
Now that borrower is going to be the only one on the contract.
No, they both be on the contract.
That would be on the contract.
Right. That would be the only borrower on the
What about
mortgage.
unmarried?
I'm sorry.
What about unmarried?
You can
And
still be on the contract.
boyfriend
Yeah,
wants
you can still both be on the contract.
to- Okay.
Yeah, absolutely. You can both be on the contract just like we do it. The only thing that's changing is that we just have to make sure that we can qualify with one person's income. I mean, don't let that stop you from buying a house. I mean, if you need both parties' income to qualify to buy the house, maybe we can get them into the FHA program where you can make a lot higher. But again, still sellers are, still afraid of the FHA, which the VA, I don't understand why sellers are afraid of. VA has a thing called Tidewater. And it's called Tidewater. A VA appraiser, if he doesn't see the value, he will exercise Tidewater. He will usually they're supposed to contact the lender. And we contact the agents. But lately I've seen them just contacting the listing agent and saying, hey, how did you come out with this number? I'm not seeing it. Can you send me your comps that you've used to get this number? I want to see your comps. Maybe I'm missing something. Maybe there's some private sales or what that I don't know of. Give me an opportunity to get your number that you need to sell this house without it coming short. VA is the only one that does that. We've done it, I would say, 2 times over the past 6 months with Sarah Hawken, and it worked. We got one up.
One in East Hampton 5-6 years ago.
Yeah, it does work. You can't do that with FHA and conventional. It is what it is. They don't give you a chance to prove your number. It's blatant like, well, I don't know, we just picked a number and they did it up through the roof. Well, then that's another thing. But if you can verify, hey, this is where I got this number. There's a couple private sales. They haven't hit the courthouse yet. Here's the data on them. And he can verify the data through the title company. Yeah, I mean, you can use those comps. And that will get you your number. And we even had cases where we were 15,000 off. We got an extra 12,000. Well, 3,000 off, they can negotiate that. You can't negotiate 15,000 because everybody thinks, no, that's my neighbor got it, why shouldn't I get it?
Exactly.
Yeah.
So Frank, I think the reason why most people aren't accepting VAs is because they are bidding the houses up. And in a conventional situation, the person's like, well, I'll just go deeper in my pocket and pull out more cash.
Right.
Where they're getting a VA because they probably either don't have the cash or
They
they
don't.
don't want to go deep in their pocket.
Yeah, no, I know, and that's a good point. Yeah, that's a good point there. But
It sucks
that's
because
the
we want
battle.
military people to be first and foremost, you know.
Yeah,
But
unfortunately.
they're at the bottom of the pile, unfortunately.
They do, it just,
Yeah,
because
unfortunately.
of that.
Yeah, money's green, not red, white, and blue. That's the problem. Where they're looking at the money. Yeah, and that's just human nature. You know, they're like, well, I think great, thank you for your service, but I'm sorry, I can use that extra money to put down on my next house to make my payment cheaper. That's what they're looking at.
Because they're selling out and they're buying out.
Yeah, yeah. No, I know. It's just, people are getting beat out $40,000 and it's cash. It's like,
Do you see this coming to an end, this?
yes,
You do?
yeah.
You see signs already?
I see signs already. Yeah, I'm seeing signs already. I'm seeing my FHA and VA volume, usually I do about 35% of my volume is VA and FHA. It went down to about 12%. Now it's back up to 27%. So I see it circling back. I see it coming back, I really do. And it's a scenario where I think we're like after the first quarter of the year, they're saying rates should probably be around 4% by early next year. It's still not a bad rate.
No.
You know what I mean? It just means that maybe you just gotta lower your home price as a buyer to get it into the mortgage price range. And I tell them, and when I qualify people, I'm like, I'm gonna qualify you for the maximum, but tell me what you're comfortable with the payment, and I'm gonna tell you the price range you should look at.
Yeah.
I have people making $17 an hour, sending in pre-approvals looking for pre-approval for $400,000 home.
I'm not gonna-
They just don't, they've never been in a situation to understand what the payments are.
But a lot of lenders don't care what you're putting on your table.
No,
They don't care
exactly.
about the dinner 3 times a week.
Mm.
Yeah, and that's just it. I'm like, what are you paying for rent? What do you come from paying for a mortgage? Well, you qualify for a $3,000 mortgage payment, and they have a heart attack. And I tell them, treat this like buying a car. Don't put the offer in, then get buyer's remorse, and try to cancel and get an attorney kill letter when we tell you what the payment is. You go test drive the car. First thing you say to the dealer is, what do you think my payment's going to be? Same thing with a house, but only the car ends in 5, 6, 7 years. House doesn't end in 5, 6, 7 years.
Yeah.
So let's find out what your payment is.
And the impact of the taxes is.
Yeah. Yeah, let's make sure that, look, you love the house right now, but if the only thing you can do is stay home, you're not gonna love the house in 6 months.
No.
It's gonna get old.
The heater goes into them.
Yeah.
Exactly,
And it's hard to
exactly.
get like a good buyer's consult, because a lot of times with these buyers, when they get their relatives in, we're like, look, I want you to get qualified for the max.
Right,
Let's see what your max is, and
Right.
then we have a conversation about what your lifestyle is.
right.
Do you take 2 European vacations? Do you
Right.
go out to dinner 3 times a week? Because the lender isn't looking at that.
No,
And we want to, like I said, just live in your house.
yeah,
But some of them are just like, no, because you're only gonna wanna sell, no, I don't wanna sell you a $400,000 house. If your
Right.
lifestyle is at the 250,
right.
because you like doing all these things.
Yeah, and I do, and I do try to go over that. Listen, I have you qualified for this. But the pre-approval letter, don't get me wrong, I'm gonna give you the pre-approval letter for your max. If you have a $200,000 buyer and they qualify for 300, I'm gonna give you a $300,000 pre-approval letter because you have to roll with the times. You go in there at 200,000 and a 200,000 offer, somebody comes in at 205 and a 225 pre-approval letter, they're gonna be, this guy can't negotiate, he's maxed out at 200. I got a guy that's offering us 205, let's go to 225, let's talk to them, not the other guy. You just excluded your buyer from negotiations by doing that. No seller in their right mind is gonna go, oh, you can afford 300, I want 300, even though the house is listed at 200. They're not gonna do that, but that's a mentality that a lot of people have. Oh no, I don't wanna let them know how much they can afford. Yes, you do, because they wanna know that if they accept your offer, you're not gonna have a problem getting financing. You're not getting in by the fact that, oh, you just bought some new clothes on your credit card, your payment went from $48 to $120, now you don't qualify. So it's a scenario where you wanna give them, you want your buyer to look strong. It's really financial survival of the fittest. make your buyer look strong. Go in there higher, go in there where, hey, these people are buying well within their means, and it'll give the seller a sense of like, hey, they're not stretching it. It should be probably easy getting to the finish line, rather than worrying about, oh my God, they don't qualify at the last minute because they didn't know about this payment that just showed up on when we pulled the credit report in the end. Because, you know, on the conventional loans, you gotta pull that credit report at the end. And we've had people, and we tell them, we send them emails, don't open up any credit cards. Don't even use your credit cards. Put them in the drawer. Raymore and Flanagan, $15,000 for the 300 payment. You know what I mean? They went out and bought the new furniture before they got in the home.
I had somebody buy a car.
Oh, we've had that.
Yes, you did.
We've had that.
I hope you like living in it.
Yeah.
And I
You see it, they said it's beautiful.
you know, I see people where they have like 2 payments left on their lease. I'm like, look, you're gonna need another lease, I get it. However, you're not allowed to go over your current payment. If you're gonna lease another car, fine, because even if it has 2 payments left, we have to count it. Where if it's a loan, if there's less than 10 payments, we don't count it. But with a lease, you have to count it because, well, they need another car. Lease is coming up.
Yeah.
We know they don't have the cash in the bank
And
because
don't
we have
put
their
it on
bank statement.
layaway, whatever you do.
Yeah. So I tell them,
What's a layaway?
your new car is gonna have to be the same payment as your current lease. You know, so shop very wisely. Yeah. Or you know what, don't do anything until after it's done. Rent a car for a month, you know?
Yeah.
Just don't do anything. If it means that I'm forcing you to not get the car you want, rent a car for a month. After we get the settlement, go buy whatever you want. Yeah, go buy your furniture then, yeah. You know,
These people, they'll put it on hold for you.
yeah, and if the
There's no cars
salesman's,
anyway, right?
the salesman's smart, he'll keep all your information and run that credit through the minute you say, hey, I'm done settlement, you know? That's what they have to do, but now we see Raymore and Flanagan and all kinds of crazy stuff pop up. $100,000 student loan popped up. Yeah, it just, yeah.
Student loan?
$100,000 student loan popped up.
I thought they don't weigh it as heavily anymore, student loans.
What's that? 2 years?
Well, student loans are still waiting. When we get,
Actively paid.
when we have student loans, what happens with student loans is they'll come in on a credit report, if they're deferred, no payment, there's still a payment. Because you have to realize that payment's gonna start within the next 30 years. You have a mortgage for a 30-year term. We don't know you're gonna prepay, so when that payment starts within the next 30 years, we have to make sure you're gonna qualify, you're still gonna be able to make your mortgage payment, or you're not gonna default on your federally backed student loan. So what we have to do is we have to take that balance and take 0.5%. So on a $100,000 student loan, it's $500 a month we have to count in the debt ratio. So if you're tipping the scales, barely qualifying, that $500 a month just kind of puts you over. Yeah, you might want to get a dorm after school and live there.
And
You
if
know?
they're not deferred, they take the actual payment.
If they're not deferred, we will take the payment, yes.
So like $100 a month.
That recently changed about 6 months ago where it was different, where we wouldn't take any income-based repayment plans. Now you can. So it made it a lot easier. Yeah, so it's a scenario where, you know,
I'm holding
it's,
out for the forgiveness.
yeah,
Coming.
just make sure you
That's
pay.
only gonna be on the federal ones.
I have a federal, yeah.
Right? The forgiveness will only be on the federal.
Yeah, I don't know anything. I'm too old to have student loans.
I would hope not, my gosh.
You know, one at the college was like $8,000 a year, you know? And I was Stanford.
That was Stanford?
I'm 4 down, 1 to go.
No, but seriously, you know, there's a lot going on. They're starting to make it a lot easier to qualify, but what we're trying to do is we're trying everything we can. We're the 5th largest lender in the nation. 3rd largest VA. We're the top 3 with USDA and FHA. You know, we have offices in every state. We have over 12,000 people in our company. And so we have a lot of leverage with the agencies, Fannie Mae, FHA, Freddie Mac, VA, USDA. We have a lot of leverage. So we're trying to push these programs out to help the consumer and help you guys get them into homes. It's not going to be this easy in 6 months. And I don't mean to sound doom and gloom, and I'm not, but it's going to be a scenario where it's not going to be this easy where like you're not going to have 50 buyers and have 20 of them get discouraged and walk away because they can't get their offer accepted. You may have 30 buyers, but it's going to be a lot more success ratio because you're not gonna see the craziness of all the multiple offers. Because the rates are gonna tick up a little bit, and you're gonna lose a lot of the opportunistic buyers that were just buying because the rates were so low, we can't miss out on this opportunity. That's what happened. I mean, you had the 10-year bond yield go down to almost 0, and the rates went down to 2, 2.25. You know, so you have a scenario where a lot of people are like, hey, I'm gonna buy now because it's worth it. And, you know, but a lot of them didn't have money, and they had to go to these grant programs to get money for the grants.
Right, we had a graph for all the stats, you stood out as far as fairway, as far as when they're number one.
Yeah, we probably have something. I can try to get that for our corporate office. Yeah, you know, we've been growing every year, and you know, it's a scenario where you know, the whole goal is like, you ever hear that JD Power, whatever it is? You know, in 2020 we won the award for customer service as a company.
That would be something good to move out to.
Yeah, absolutely. Yeah, absolutely. I'll definitely try to get something over to you guys. But so, you know, it's a scenario where you use these programs. If somebody says, hey, I think I have credit issues, credit problems, don't say, oh, okay, well, come back to you when they're fixed. No, send them to us. Let us take a look at it. A lot of times people are overly cautious. I have people say, oh, my credit's probably terrible. They had a 700 credit score. They thought it was terrible because they missed a couple payments a year ago. You know, so let us take a look. We have that credit tool program. If you're not familiar with it, credit tool program is if your credit score is not there and you need help, we don't tell you to go to Continental Credit or some other company to get help where they charge you like $400 up front. Then they charge you $79 a month until your credit is fixed. And the reality is what they're doing is they file disputes. File a dispute on the credit report. What happens is that account is now removed from the credit scoring process. So if you have 3 collections and you file disputes on 3 collections, now your credit score is calculated on everything else but those 3 collections. So you're going to get this higher credit score, but it's a false reading. You can't get a mortgage with disputes on your credit report because we know that's not a real credit score. That's what these credit companies do. When we have our credit tool division, it's totally free. We cover the cost for the consumer. It's expensive, but we cover the cost for the consumer to have basically people, you know, future business for you guys waiting there when we get them back to normal. We had one done. Donna Myers is not here, but Donna Myers, we had in VA. They let them rent for 6 months, and in 6 months we took them from a 480 to a 660. And yeah, and what they do is if they're credit advisors, they're professional credit advisors. They work for our company. They're not outsourced, and they communicate with the consumer. They're actually able to go into the credit bureau and do mock manipulations to see if we do this and change that, if they pay this collection off or they pay down this balance or open up a couple new credit cards, what will it do to their scores? And we'll let them know the target score we need. So they'll create that blueprint, email it to the consumer, even sit down and talk with the consumer over the phone on what to do, or they'll do a Zoom call. We had somebody I needed to get credit cards because all they had was like an old auto loan that was paid off a couple years ago and they had no score. Well, they have a list of credit card companies that will extend you credit without having any credit. There's even a couple of them that don't even pull the credit report because they're secured cards. But now you got this credit card on your credit report, and now you have credit utilization. And that's what generates a credit score. You could have 20 credit cards, not use them in 2 years because you don't like to use your credit cards, you're not gonna have a credit score. But then you could have 20 credit cards, have them all maxed out, but make every payment on time, never miss it, have a low credit score because you're maxed out on your credit cards, you're utilizing your credit usage too much. So there's a fine line there, and what they do is they develop that fine line with the consumer, and they basically get them to where they need to be. It could be a month down the road, it could be 6 months down the road. But the reality is, if it's 6 months down the road and you're going to settlement and you're getting a check and you're getting closer to capping where that makes you cap, well, that's a client that you would have probably just turned away and walked away from, never heard from again. So this kind of incubates that client that's not ready right now. Kind of like a baseball team. So they're not in the major leagues, put them in the minor leagues till they're ready to play in the major leagues. And that's what it is. We incubate them. As long as they follow the program, a lot of times people will get it and they'll start out very gung-ho, and then they'll get the itch of buying a home is gone.
Yeah.
and, or the, you know, or the glitz and the glamour of looking at homes to buy. And then they'll get the printout or the blueprint of what to do, and they follow up with them. Hey, just following up to seeing how you're making out with these accounts. Half the time they ghost our advisors. They don't call them back. You know, they don't reply to their emails. And then it's like, if you don't, it's not going to happen if you don't want it. You know, and I'll reach out to people and they're like, oh well. I was like, listen, I get it, I understand, but you know, when you're ready, get back to them. They may have to draw up a new blueprint for you because you're not going to be able to buy a home unless you fix these things. You
It's
know.
not funny that they ghost you and all you're trying to do is help.
Help 'em, yeah.
Well, Brian, I have a ritual every Saturday. I make phone calls from 9 a.m. to 12, and then I'm usually running, you know, updated pre-approvals and numbers for the rest of the day with agents. But I'll call those people that I can't get in touch with during the week because maybe they're working during the week. They have kids in soccer or whatever, and you know, maybe they work 2 jobs, and hopefully I catch them if they're off on a Saturday. You know, sometimes they do, sometimes they don't. But on average, I do get a good bit of them on a Saturday, and at least I can, you know, say, okay, this is going to go through. If the agent say, listen, they're just running into a little delay fund-wise to take care of stuff, or forget it, they're not going to do anything.
How do you, get them into the program?
Basically, we have to get a pre-approval submission in, whether it's through our app or our website, because we have to run a credit report to see what their credit looks like. And if they're okay with the program, we send them an authorization letter for them to sign. They sign that and send it back. We have to do that to be compliant. Once we have that, we go in through our processing system, and we go to the credit tool link, and we just upload that, and we put in there how much money the borrower has to satisfy debts, and we ask them those questions. What credit score do we need to get them to? So if we need to get them to a 620, it's a lot easier to get them to a 700. So at least they'll know what to do with these systems to manipulate the data to get the credit score simulator to work to where they can send them that blueprint to say this is what you need to do. Sometimes it's simple, like I said, is opening credit cards. If you have anybody needs to open up any credit cards, Discover Capital One. They can go online, get approved instantly. They approve everybody as long as you're not bankrupt. You didn't file bankruptcy, your credit score is okay. Capital One and Discover, they're the 2 that I've been telling people to use and get credit cards. My daughter, she never had no credit score, never had any credit, and she got a Discover Capital One card in 5 minutes.
The secure one or the regular one?
No, regular.
Really?
Yeah, and and that was our credit tool division said, save it a step. Just tell them to go to Discover and Capital One online. They're giving everybody credit cards, and we're talking like $4,500 limits. When I was opening about $500 limits. When I saw my daughter,
Discover's doing that?
huh?
Discover's doing that?
Discover's doing it too. Yeah.
Wow.
I saw my daughter had like 2 credit cards with those limits. I was like, oh boy, it's going to be a problem.
I know in 6 months.
This is so funny, you pay off your credit cards, I know my husband and I, you know, and then we just got in the habit of, okay, we just pay cash. We better charge something, right? Is that what you're saying?
You have to use them. It basically, in other words, how do we know how you pay your bills if you don't have any? We need to see that you've opened these credit cards, you're using them, you have some recent loans that you're paying on, because those, as you use your credit cards, that's what generates your scores. Oh, you're using them, you're paying them on time, and you're not going past 30% of your limit that they give you. That's the key. Keep it below 30%. So if you have a $10,000 limit, you're not going above $3,000, and if you have a $1,000 limit, you're not going above $300. Because once you go above, it starts to look like it's risky. Because when we run a credit report for a mortgage, they have a risk factor there. Well, if you have 10 credit cards that are maxed out, you're living above your means. How in the world are you going to pay a $2,000 mortgage payment on top of it when you can't even afford your current lifestyle because you're maxed out on your credit cards? That's how they do it. Yeah.
So the 30% per open line of credit?
Yeah, 30% per credit card. Whatever they give you as a limit, don't charge above 30%.
But each one you have.
Each one you have, yeah. Some have different limits. Yeah, some have different limits. So each one is individual, 30%. And I tell people, listen, just use it, go get gas, buy lunch or whatever, set up the auto pay to pay the minimum payment. You want to pay the minimum payment and just monitor it online. Once you see it building up to where, say, if you put $100 on it, but your minimum payment's only $25, once you see that building up, getting to be close to 30%, just pay half of it off. And you want to make the minimum payments. You don't want to pay it off very long. Just make the minimum payments, let a balance accrue on there and stay on there and show them that you're paying it. It's like having experience. It's like credit experience. You're applying for a job. They want to see credit experience.
Would you suggest you pay it off in 6 months or just let it go and be?
Well, if you get your mortgage, do whatever you want with it. You know, you vault on it at that point. As long as you get the mortgage and get your commission check. You know? But you see what I'm saying? You know what I mean? Yeah, these are little things, and I'll talk to the people. You know, we have people with scenarios where you know it's like you have all these credit cards, they're zero balance. Well, take your kids out for lunch or something. Do something. Try something. Stop paying cash.
Yeah.
You know, and yeah.
Cause they'll close it, my Discover closed because it had a student IT card and I hadn't used it in like 4 years.
Yeah, well, what happens is, the system's designed to do that because at that point, it assumes it's lost. And if anybody picked it up and used it, they're not gonna accept the charge, they're gonna call you to make sure it's legitimate. You know, so that's what you have to do. I swear to God, every time I go over to the King of Prussia Mall with my wife, I get a phone call from American Express. Are you so-and-so at King of Prussia Mall? That's supposedly in this area where everybody sells credit cards, they go right there because you have all the high-end stores there.
Yeah, Louis.
So yeah, every time we can go get a salad, and if I use my credit card, they'll call me because they see the location. It's funny how they do that.
They do that
It's
every
a
time
fraud.
on the shore.
Was that?
Every time on the shore, they do that.
Yeah.
Like, it'll get declined, and I'm like, I know.
Yeah.
I'm
Do you
sorry,
travel?
Hold on a second, I'll get a call in a second.
Yeah. Basically.
Yeah, they have their hotspots. They know.
It happened to me at the Ritz-Carlton. I was on a work conference. I was so embarrassed.
Yeah.
And my credit card, they were like, and I kept trying to get a hold of somebody because it's California time.
Yeah.
And
No, I know. It's funny. It's like you know. It's like oh, we're gonna strike my phone ring. We're here. You know.
yeah.
But,
I think on a lot of them, you can give them a travel notice. You're gonna.
I do
Some
that all the
people
time.
don't take it, it's even that won't take it.
Really?
What,
Cause
a
I have,
travel notice?
I have a kid in Texas, one in Wisconsin and one in Denver. And I went to IKEA, bought my son's old furniture in line, bang, declined, like.
Great. I'll get with you. I know you said you're gonna be late. I'll get with you. Just go over a recap. Pretty basic stuff. Anybody else want to meet afterwards? We can just sit down at a table, go over any question you might have, anything you might have missed. Came in late.
I think I'll go tomorrow.